We know there are financial challenges in the sector. Everybody knows that. Luke highlighted it again this morning. From Unimutual's perspective, we are here to play our role in helping you in containing your costs. And after talking to members, particularly over the last couple of months as a recurring theme, cost of protections has come up. For those who are new to the mutual, protections are like insurance policies, but when you're a mutual, you don't offer an insurance policy. And we don't do premiums, we do contributions. So the language is a bit different, but that's why we call it containing your contributions. Hopefully today I can demystify a little bit about underwriting and pricing. I hear a lot of great things from people who tell me how pricing works, and it's because they were told by someone who was told by someone whose second uncle told them once about how insurance pricing works. So hopefully we can demystify some of that. But what we're going to do today is cover off how we price our portfolio at Unimutual, what are the influences, particularly of the property contributions, because that's the biggest policy that most organisations have with us. How does the formula work? And I think it's important to understand, when we talk about pricing, there can be a bit of confusion around what pricing means. Market trends, reinsurance costs, because they're a big chunk of the cost of our contributions because of the protections that we offer, and how to contain them. I will offer this disclaimer because I need to. Today's information is general in nature, and members need to consider their individual needs and seek advice where appropriate. Compliance manager Natalie just cheered, so that's great. So Unimutual, those who've been with us for a while know why we are here. We are a sector body that was created to support the sector, and we like to say that our members work with us to create value by the members for the members. It's tailored cover for this sector because we understand it, and I commend Simon and the team with TEFMA and with the other bodies on that piece of work, because it's sector-specific work that we need to do. We have active involvement from our membership, whether it be on the board, on our different committees or reference groups, or at events like conferences. Our members have an active part to play in your mutual, and it's fantastic. But today we're going to talk about cost, and from a cost efficiency perspective, that's what we're here to do as well. Our expense ratio is 8% of the income we generate. We run a very efficient operation for our member organisations. And coming from a general insurance background, let me tell you that expense ratio is extremely low. But we don't sacrifice quality for that. We just focus on the things that make a difference to our members. Further details will be available at our AGM next week. So for those who would like to come along and hear the great story of our last financial year and the surplus and what that means for our financial sustainability, please come along to the AGM and hear more about it. So how do we price our portfolio? So like general insurers, we calculate our portfolio price looking at claims costs for our portfolio, looking at the reinsurance protection costs that we have, looking at administrative costs, and then looking at the investment returns that we make on the funds that we hold. Reinsurance protection costs. So for those who don't know what reinsurers are, they effectively sit behind us to provide the capital to give us the $1.4 billion cover that we protect our portfolio with in the property side of things. And the $250 million of cover that we provide for the casualty classes. So that's what the reinsurers do. They sit behind us in partnership, A- or better S&P Global Security. So they are reputable organisations that are financially sustainable and stable, and they're the people that we partner with. But it comes at a cost because we need that capital to provide you the cover that you need for your organisations. Unlike general insurers, Unimutual doesn't load in a profit margin. So general insurers load in a profit margin to then pay to their shareholders who provide them the capital. We don't have that. You are our owners. So from that perspective, we add on a small part, which is to cover for unforeseen risks, to make sure we're financially sustainable. Been around for 35 years, and I won't be around for the next 35 years to lead the organisation, but I want to make sure that the organisation is around in 35, 40, 50 years to continue to do this for this sector. So that's the way that we work. And again, if you want to find out more about that, come to our AGM next week on Wednesday, and you can hear about that. When we look at the portfolio, so that's to price the portfolio of Unimutual. Then how do we break that down member by member and price it member by member? And our members do ask, how does that come through? What can I do? So the three parts to your pricing look at the individual risk exposure. So myth number one I'd like to bust, we don't have community pricing. Everybody doesn't pay the same rate. What we do is we go through all 62 members and we look at their individual risk exposure. I'll cover a bit more on that in a little bit. We look at the retention level that you hold. In insurance language, that would be your excess or your deductible. But the retention that you hold as a member and your claims experience. So individual risk profile is looking at things like your COPE information. Very important part of the data collection process, which starts sooner than we'd like, but that will start very shortly as we head towards renewal. And COPE is around, what's the construction of the buildings that you have? What are the buildings made of, so that we can understand how they'll perform in a natural catastrophe event or some other event such as a fire loss. The occupancy, underwriters look at how a building is used. A research lab is going to have a very different profile to that of a lecture theatre, to that of a student accommodation, to that of an admission centre. The protection, so how do we safeguard those assets? Is it fully sprinkled? Is it fully sprinkled with a single water supply, or is it dual water supply? Is it partially sprinkled, non-sprinkled, fire alarms? All of those pieces of information are critical for us to understand risk and to be able to differentiate effectively on pricing based on protection information and exposure. And it's natural hazards as well as non-natural hazards. So non-natural hazards would be things like the area it's located, whether it's susceptible to vandalism, graffiti, those sorts of things. And natural catastrophes, in Australia we're very aware of, particularly in recent times. So that's what we look at from a COPE perspective. That's your risk profile. Claims history, we look at 5 to 10 years worth of claims history, and it's not, as when you pay your home and your motor insurance, if you have a claim, you get whacked by someone. We actually just look at that claims history to say, well, what does that tell us about the type of risk that we have? And if we have somebody that we're looking at for consideration, particularly for new members to the membership, what does that tell us about their risk culture? What does it tell us about how they perform, so that we know and can charge an appropriate price for the risk? Because claims is a good indicator of some of those things. So we'll look at 5 to 10 years worth of history on claims. It's not just a single year. Yep, you've had a great year last year. We'll price appropriately. We look over the longer term. And then retention levels. So as you'd expect, if you take more risk yourself as an organisation, the price generally comes down. If you take a lower retention and pass more of that risk through to Unimutual and the reinsurers, then the price will go up to cover that, because you're taking less risk and the mutual's taking more risk. So how does that carry through to the pricing? And one of the things that I've been trying to give transparency to over the last couple of years since I've been on board with the team is really to explain how this works at a more detailed level, because that's what our members want. They want transparency in pricing. So from a property perspective, we have a rate that gets charged, and that rate is a view of your individual risk exposure, your retention level, and your claims experience. I won't go down into how that comes together as a rate. A, because it's intellectual property and our competitors would love to have that. But B, it's complex. It's not an easy thing. It's been reviewed by actuaries, which takes it out of the realm of what I'm capable of. Isn't that right, David? And then asset value. And asset value is the measure that we rate things against. So if you're a larger organisation, you have a larger risk because of your profile. So it's rate times asset value. And what you hear in the insurance industry, a lot of people will say rates are coming down. That doesn't mean premiums or contributions are coming down. What it means is that the left-hand side, far left of the equation, is reducing. The bit that we sort of forget in the middle is what's happening with the base measurement, which is the asset value. And asset values come from your valuation that you do every 3 years. That is intended to be a fair reflection of the insured cost of replacement of the assets that you have. So when you times the rate by the asset value, that equals your contribution. It's a fairly simple formula as such, but as I say, the difficulty comes in that rate piece in calculating that. So to bring that to life a little bit, I've got 2 examples there. Member 1 had a rate of 0.25%, or 25 cents, as underwriters would call it, on an asset value of 250 million, and when you times 0.25 times 250 million, you get 625,000. Now, assuming a rate reduction in 2025 of 5%, and I just made this number up, okay? I'm not guiding you that that's what rates are going to do this year. I just made that number up for simplicity. But if we reduce the rate by 5%, it comes down to 0.2375. So fairly easy sort of calculation on that. Now, if asset values increased by 4% this year, and that's sort of the long run average of construction cost increases, you would see that asset value would go from 250 million to 260 million. So when you multiply the new rate by the new asset value, you get 617,500. Equally with member 2, 0.14% as a rate on $2.2 billion. It's just over $3 million. If you had a 5% reduction in rate, it goes down to 0.133 times 2.288 billion to get 3034. So it's a fairly simple sort of thing. It's the same for every member in the room. So it doesn't matter your business type or your size. It's the same formula that works through. The numbers would be different in terms of your values or your rates. So, market trends. We've seen, and I talked about this last year and at every opportunity I get, so we have seen increasing frequency and severity of natural catastrophes, increasing claims costs due to hyperinflation in the building industry, and we know lack of labour, we know lack of materials as well, supply chain interruptions through a number of wars and a number of tariffs and trade challenges do feed into that, and a high level of general inflation. From a natural catastrophe perspective, over the 30 years between 92 and 2002, I would have had a more up-to-date slide, but I couldn't find one. They haven't been published yet. But over those 30 years, you can see that trend line is trending up just in the last 30 years. And these are global numbers for natural catastrophes, either weather-related or quake. Obviously, quake is a little bit different, but you can see the trending line, which is an impact of climate change through the storms. We just saw in the last couple of weeks Tropical Cyclone Alfred. I think this time last year in Future Campus, I said we are likely to see cyclones come lower and stay longer, and that's what happened. So we're going to see more of this going forward due to climate change. It's just a factor of what we're going to see. From an exposure perspective, this is the asset value piece. We've seen sort of numbers historically low. If you look at 19, 20, 21, you go before that, the range is sort of around the 2 to 4%. Between 22, 23, we had significant increases in valuation increases for rebuilding costs, and that was off the back of the construction building index. We have reduced over time. We've got over that hump. But they are still, at levels higher than historically that we've seen. So for members, you need to factor that in to your asset valuations so that you don't end up with a surprise at the end of the day based on a shock valuation. So how does this impact underwriting? So general insurers and reinsurers adjust their portfolio mix at these times. Reduced appetite for some sectors. So on a liability perspective, we see the leisure sector is one that really struggles to get cover, as did this sector in the late 80s. And the reason we were created was due to that in 1989. The leisure sector are seeing that in the casualty space, and Northern Australian risks, we're seeing insurers leave that market in favour of government pools coming in. So that is an example of how changes in climate change and losses do impact this market. I've said rising reinsurance costs there. I think I left that one in just for conversation to highlight that we think we've started to turn the corner now. Last year we had rates, reducing, which was great after a number of years of increase, which meant we could pass that reduction through to members. Too early to call yet on what's going to happen this year, but we'd like to think that that trend will continue and we'll see some easing of rates going forward. I produced an article on this 18 months ago, and I think I might have shared it at last year's conference, but I thought it was just very quickly just to go through. We talk about hard and soft markets, and this impacts a big part of our portfolio because we buy reinsurance to protect the membership. Effectively a hard market is when conditions are really tight, prices are going up. It's difficult to place risks. You've got to put a lot more effort into selling the quality of your account. Because underwriters, they set the rules. And as time goes on and they make extraordinary profits, they start to get more competitive, more capital enters, and you'll see through the cycle, if we start at a point where we were a number of years ago where rising natural catastrophe losses, rising claims costs, so prices started to go up. You then have the compounding effect that you're still not getting the price you need for the risk and you're still wearing the losses. So there's an increase in losses through that. Stricter, have I gone battery? No, I'm pressing the wrong button. Stricter underwriting and reduced capacity. And this is where underwriters generally look at more exclusions, narrowing cover, being really selective in the things that they'll protect and the things that they won't. Resulting in higher premiums. And then as time goes on, better than expected returns, compared to the losses that they're facing. Additional capacity enters the market because everyone says, isn't this a great industry to be in? Let's go and invest there and make some great returns. But the more capital you've got, the more competitive it becomes. So pricing becomes an issue. And then premium rates start to fall. And as I say, this time last year is where that started to turn. We started to come back into a softening position. I wouldn't say it's a soft market by any extent, but it's certainly starting to soften, and that's really important to know. So how do we influence protection costs? Because sometimes it feels like these things are done to us rather than being done with us. So we've got a few things that we'd like to cover. What does Unimutual do about it? So this is our strategy on a page. Don't try and read it. It's very busy. I put it up there just to show that we've got one. And I know at last year's conference I discussed it and the year before. So if you want to go back to the videos from those, you can refresh on that. But pillar 5 here is called manage the cycle. And what we would say is while we cannot control the global reinsurance market, we influence the market. And we do that to try and smooth the insurance cycle, providing coverage and certainty to our members. And we do that by working with our members to improve the portfolio so that when Tobias and I go to talk to our reinsurers, we've got a really good story to tell about our portfolio. That's the time when we get out and really sell the value of an insurer being a part of our program. So how can we contain our protection costs? Risk improvement actions. So Simon and Greg, go out and do a lot of engineering surveys. They do a lot of consulting work on new builds for new construction. They give advice on where to spend maintenance money, where do you get your best bang for your buck. But their job really is to ensure that we help our members understand their risk profile and how it can improve. I said to the team when Cyclone Alfred was heading down the coast, I said, this is where the rubber hits the road for us. This is where the hard work working with our members pays off, because when this thing sort of goes inland, because of the work our members have done to improve their risks, this is where the benefit pays off for them and ultimately for the mutual, but more importantly for them, so their facilities aren't impacted. How can you help, or how can your organisations help? I think considering what additional actions you can take to reduce your risk profile, actively looking for areas where there is risk, and so, well, from an insurance perspective, from a protection perspective with the mutual, how can we be better? How can we focus on that, do something a little bit differently for a better result? Ensure the recommendations from risk surveys are done. We have a very good completion rate on our risk recs over the portfolio. The last 2 years at renewal, we've given all members who've had surveys done a view of what your risk recommendation completion looks like. The reinsurers take a long, hard look at that information because they want to know they're working with people who understand risk and take an active involvement in mitigating risk. So don't think it's just an exercise to keep Simon and Greg happy. It's actually an exercise that the reinsurers take a lot of interest in because they don't see a lot of accounts like ours with such a focus on risk management. So that's why they love our portfolio, but we need to continue to drive the completion of those recommendations. And I'm not talking about the real capital intensive $5-10 million sprinklering of buildings. Sometimes it's as simple as making sure that when we've asked for wooden pallets to be removed from the western wall of the Vice-Chancellery, that they get moved. Or that a hot work permit is brought in and documented for all of your contractors coming on site. It's those simple things that don't cost a lot that can make all the difference. So I'd encourage everyone, if you're not familiar with the risk recommendations that the team have made, please go into Resure and find them. Please reach out to the team and find out what you can do to make a change, because the better we can show our portfolio, there's a direct pricing impact on that. I can't overstate that point. What we're looking to do the last 2 years, we've shared the information with members to say, here's what your profile looks like compared to the benchmark of the sector. We have 70% of the public universities in Australia, so we've got a good view of the sector. It's great to benchmark ourselves against that. But what we're looking to do as we go forward, we've got a lot of members who say, I do all this great work, how does that factor into pricing? So this year at renewal, we're going to give more transparency to our members to say, because of the risk recommendation profile that you have, this is what it's going to look like for your pricing. Not going to bring it in yet, but we're going to show you some of the impacts. Because what we'd like to do is engage the membership over the next 12 months about how we might bring this to life for you to help you. And then in future years, you'll be able to clearly see in your pricing how risk recommendation completion has impacted your pricing. We don't think it's fair to spring things on people and say, ta-da, this is what it means. And if you're on the lower end, then you're going to get hit, right? We want to roll this out over time. We want to consult with our membership. But that process started 2 years ago with visibility of your position compared to the industry. This year will give you an insight to what it could look like on pricing, and then we'll consult maybe with a view to the next renewal. Setting your member retention. It's easy to just up or down your retention based on what you've got to spend. I would just encourage, look to your organisation's risk appetite. You set your retention on a long-term view. Don't just do it year to year to save a couple of bucks, because it may go wrong for you. If you're going to take more risk by increasing your retention, looks great for your CFO until the claims start to roll in, and then you're taking a higher retention on those. Equally, if you're comfortable in your risk management and your organisation has the right risk appetite, then you should be looking to increase your retention and save that money, because effectively, you're not making the most of that work. You're doing all the great work in improving your risk, but you're not getting the benefit of a lower cost. So consider your member retentions. We will look this year to try and offer proactively some different retention levels so that you've got some comparisons to do. But if you do want a different retention level, make sure you reach out to the team and we'll make sure that we get the pricing in line with that for you. Asset valuations, really important. We don't have a co-insurance clause or an average clause on our policy, on our protection. An average clause in general insurance speak effectively says if you under-declare your values, then you pay that proportion of the claim. So if you under-declare your assets by 20% and you have a claim, then you pay 20% of the claim. That's what a co-insurance clause says. We don't have one of those on our protection, and we fight to keep that. But to be able to do that, we've got to show that our valuation of our portfolio is fair and reasonable compared to the replacement value. So that's why we ask members every 3 years to provide a professional valuation of their assets from an insurance perspective, because we don't want to be in a position where we're forced to take this co-insurance clause on that is usual in the general insurance industry. Got to be a reputable firm, done every 3 years. I would say, ensure that it covers all the assets that you need to protect and doesn't include the assets you don't want to protect. Don't pay too much for things that you're never going to rebuild or claim. Now, the last 12 months, I've had a few members who've said, we're actively looking for assets that have no book value, fully depreciated, and we'd never rebuild them if they burnt down. So we're not going to protect them this year. Great. But think through the implications of that if you have a partial loss. If you have a water damage claim, Simon was talking about the $2 pipe that bursts in the roof. If you have a $3 million water damage, $4 million water damage claim, what would your organisation do at that point in time? Because if you're not covered for it, either you have to pay that as an organisation, that $3 or $4 million, or you've got to shut that building. So don't think in terms of no loss, total loss. Think through all the scenarios there, because it does concern me, and I feel an obligation that we highlight that with members. It seems like an easy decision to make. I'm just not going to protect some buildings. Great, but think about all the scenarios, because you don't want to be in a position you haven't protected it, and then you have this water damage claim or a partial fire smoke damage claim, and then you've either got to stump up or you close this building that's not damaged enough to knock down. So just think those through in your decision making this year. And if you need help, reach out to Tobias or myself or the team to talk through your thinking on that. Don't give us surprises at valuation time. Let's talk about it early so that we know what's coming and we can help you with that. Last one's data quality. Data collection is coming up. It's imperative that we have the most complete and accurate information to support the underwriting process for ourselves, but our reinsurers. Reinsurers, and having been one for 15 years, I know, if they don't have the information, they'll make it up. And they won't be optimistic about risk. They'll always be conservative. All right? The catastrophe models particularly will try and pick an average profile bordering on conservative. So take the time to complete your data requests, particularly your COPE information, to the most accurate you can. Because if not, then the reinsurers, the models themselves will actually just be very conservative, and you might leave some money on the table there where you're paying for risk that doesn't exist. I promised I'd get out on time. I'm doing all right, I think. So next steps. July this year, as we always do, we will have our standard renewal pricing webinar. After we've engaged the reinsurers with our half-year update and sensed where the market is, we then run our webinar to try and give guidance to the membership on where we think pricing will be for all of the covers that we offer. We try and get as close as we can. There's no point saying it'll be plus or minus 20%. That range is ridiculous. We try and get as close as we can so that you can start budgeting, because your budgeting cycle starts really early. The thing that I would say is we will give advice on that. We can give a view on where we see asset valuations, but you really want to make sure that you're factoring in what your asset valuation is going to tell you. The only member, we had one member out of all of the members last year that the result was a surprise to them. It's because they underestimated the valuation change. If it was me, I would actually run the valuation process in line with your budget process. If you need to start budgeting now, I'd have your valuation done at this time of the year, because you already know that middle part of the equation. You can lock that in. If the assets have gone up 6%, you know 6% is the locked in number. And then in July, we'll tell you what's happening with the rate, and then you can try and guess what that means for budget. But look, that's just a personal thing. There's obviously other things that institutions need to think about, your timing of valuations. But if it was me, that would help from a budgeting perspective. And as always, look, we're here to help. The risk management team, Simon and Greg and Glenn, do an awesome job at advising members on risk, and they're here to help and happy to help at any time. The member services team are outstanding in terms of turning queries around. And the underwriting team, who at the moment is Tobias and David Borum, with Celinda moving up to Singapore. Next week we will be announcing Celinda's replacement, which is great news, and we'll have an underwriter, casualty underwriter, on board very shortly thereafter. So exciting things happening, but we're here to help. And I had hoped to leave you some time, but what I'll do is, if anyone wants to ask any questions, catch me outside or drop me a note at any time. And yeah, looking forward to a good renewal. Thank you.